Good morning, it's Jeffrey Christian of CPM Group. It's about 10:45 here in New York on Friday the 16th of August. Let's talk about the economic environment, GDP, some of the data that's been coming out this week, and what it all means both for interest rates and for gold and silver. We are seeing some very interesting developments, and the markets are having to adopt a more nuanced view of the state of the economy. I'll talk about that, and then I'll talk about our market outlook for gold and silver. I'll show you some charts in a second, but let me just run through some topics here that I got a lot to cover, so I want to try to not be redundant, but I do want to cover it all. Real GDP in the United States and on a global basis. I want to talk about that, show you some numbers, show you some historic data. I have here that I refer to George H. Bush's era in 1992 recovery and election. We had a short, shallow recession in 1991. In 1992, a lot of people were still suffering the same way they are suffering now in the post-2020 recession and 2021 spike in inflation. And President Bush, the first, didn't really pick up on the pain that people were feeling. And he kept, during the campaign, kept saying, I don't know why people are complaining, the recession's over. He was looking at the macro data, and he wasn't looking at what it meant for people's lives. It was also the first recession that hit white-collar workers harder than blue-collar workers. And back then in 1992, that meant fewer satisfied Republican voters relative to Democratic voters. That's shifted between the 1970s and the late 1990s politically, but that was the case at the time. It cost him the election. He blamed the Fed because the Fed raised interest rates in the months before the 1992 election. And he blamed the Fed's rise in interest rates as why he lost the election. But that wasn't it. What cost him the election was he seemed out of touch with what meant to important to the American people. I'll also talk this week about some of the data that's come out and what it all means for interest rates and the market sentiment started to interest rates reshuffling. Upcoming events. There are going to be several factors occurring over the next several months that will have an important effect on market sentiments toward interest rates, toward the overall economy, toward financial markets, equities and bonds, and toward gold, silver, and precious metals. Jackson Hole, the Kansas City Fed's annual conclave in Jackson Hole, Wyoming, will occur the 22nd through 24th of August, the end of next week. And people will pay a lot of attention to what's being said both by Fed officials and by people that the Fed, the Kansas City Fed, invites to speak there. So that's going to be very important in terms of this attitude that the market has toward things. In addition to that, then, in the middle of September, we have the Federal Open Market Committee, Federal Reserve Board's Open Market Committee meeting. They have two more later in the year. We have the elections on the 5th of November here in the United States. Both the presidential election, but also the congressional elections are going to be very important. Now, before I get into all of that, we have this fellow who, asked me a week ago in the comments to one of our videos why the Fed is short gold on the COMEX if it doesn't care about gold. And I pointed out that the answer is very simple. The Fed is not short on COMEX gold. The Fed doesn't get involved in COMEX gold. The Fed doesn't really get involved much in gold these days, the last several decades. And he's been lied to, and he listened to the wrong person. His response was, thanks for answering the question. It's hard to believe that Andrew Maguire and Ted Butler could be so wrong on this. I'll get back to this with a response at the end of this. After I go through the economy, I'll talk about our outlook for gold and silver, then I'll deal with my answer to this. It's a very interesting one, and you probably want to stick around. This is CPM Group's projections of world GDP over the next 10 years. And I believe I showed this to you recently. We update our economic outlook, our outlooks for gold and silver, supply, demand, and price on a quarterly basis. And we recently completed our gold quarterly update. We're completing the silver update this week. We expect a recession, 2025, maybe starting in the fourth quarter of 2024 already. The economic environment is extremely uncertain and unclear. It's very mixed right now. It's mixed in a way that is sometimes characteristic of the period just before recession starts, when the clarity of where we are economically is clouded. It causes not only monetary authorities, but congressional authorities, businesses, and consumers to pull back on their spending and to modify their policy behavior in ways that sometimes can combine to actually trigger the recession that people are worried about. And we're in a situation right now where that could be happening. The data that has been coming out, which I'll run through, PPI, CPI, retail sales, industrial production, has been very mixed in recent months, indicative of a maturing economy. And the question is, do we have a recession or do we have a soft landing? And I've always said that a soft landing is an extended period of a mature economic activity before the next recession. This is just breaking that out and looking solely at the U.S. And you can see recession, where you can only see a little bit of the 1980 recession here. We had a double dip recession in 1980 and then 81, 82. Came out of that. We did not have a recession in 87, but we came very close in 1990. We had, on a full year basis, we had positive economic growth, but we did have 2 quarters of negative growth in 1991. That was that recession during the George H. Bush administration that I mentioned. We had another recession in 2000. It doesn't show up in the annual data, but we did have a couple quarters of negative growth. We recovered. Then we had the Great Recession in 2007 to 2009, the 2020 COVID lockdown recession. CPM Group's expectation is that we could have another recession within the next 16, 18, 24 months. When we come out of it, we think that growth will be more anemic and less dynamic than it had been. I want to look at historic U.S. real GDP. You can see here viscerally that the U.S. economy overall has been less volatile since World War II. Prior to World War II, you can see these big spikes down, 1880s, 1870s, 1890s, depressions. The 1930 depression, the spike in the 20s that led to that precipitated and contributed to the Great Depression, World War II and the post-war expansion, a big recession in 1947. And then we entered this period of less volatility. There were still a lot of recessions, 3, 4, every 4 years, every 6 years you'd see a recession. And that was the case between 1950 and 1983. You still had recessions, but they were shorter and shallower than they had been prior to 1948, 49. And you had then a change in 1982 with the advent of Paul Volcker as the Federal Reserve Board chairman, change in policies there. You had this massive fiscal stimulus under Reagan and George H. Bush. You saw interest rates averaging about 7% or so during that 12-year period, by the way. So, 3%, 5% interest rates aren't necessarily scary. The strongest growth period that we had in recent decades was based on a period when we had about 7% interest rates. So, c'est la vie. After 1992, we moved into a period of even less volatile economic activity and longer periods of time between shorter, more shallow recessions. And that lasted until the Great Recession in 2007. But that is the history of recessions. And interestingly enough, all those recessions have ended. Some of them are pretty nasty. Some of them turn into depressions. We haven't had a depression in this country since the 1930s, since before World War II. But recessions, generally speaking, are shorter, shallower, with longer periods of time. You might call them soft landings between recessions since 1982-83. That's the economic overview to pay attention to, even while you're feeling the pain of other factors. Now, CPI came out. Headline inflation was down to 2.9%. That's the blue line here. Core inflation, which includes food and energy, was down to 3.2%. So what you saw was a very mixed picture for CPI and for inflation. And the day before we had PPI, it was a similarly mixed picture. Yes, inflation rates were falling, but they're still very high. Important sectors continue to show inflationary pressures. And in that environment, the Fed will say, yes, we do want to lower interest rates because we're seeing economic weakness of sorts in different pockets and segments of the U.S. economy, but we still have to worry about inflation. The inflation battle is not over by any shake of the imagination. So this has caused financial markets to curb their enthusiasm. They had shifted, and the Fed has been pretty steadfast in its policies and its statements about its policies, but financial market sentiment has shifted all over the place. Oh, we're going to have a recession in 2022. No, 2023. No, 2024. No, we're not going to have a recession. We're going to have a short landing, a soft landing. And the Fed's going to have to lower interest rates, and they've been saying that ever since the Fed was raising interest rates to quell inflation. And the markets got very enthusiastic. Oh, the Fed is certainly going to lower interest rates in September, and maybe they'll have to do it before the next Fed FOMC meeting in September, which was the latter part was totally unrealistic, and the idea that the Fed will lower interest rates in September had like a 50-50 chance of actually happening. But the markets were determined that this was, got to believe this is going to happen because I think lower interest rates are important. And we've pointed out in numerous videos, you have to be careful what you wish for. Lower interest rates will occur when the economy is slouching toward a recession. Lower interest rates will not necessarily signal economic well-being. They will signal that the Fed and other financial entities are extremely concerned about the real economic trends that they're seeing, which point to a recession. So lower interest rates are not all that great of a thing to pray for when you go to bed at night. And CPI is showing it's a mixed picture. So we've seen over the course of the last few days a shift in financial market attitudes and sentiments and beliefs from, oh yes, the Fed will almost certainly lower interest rates in September, to, well, maybe it's a 50-50 chance. And our view is that there is still a 50-50 chance. If you look at the CPI, not in year-over-year data, but in monthly data, again, you see this mixed picture. Food purchased for consumption at home, the prices rose 1.1%. That is much lower than it has been. Food purchased for eating out was still high at 4.1%. That's partly a factor of the fact that food eaten away from home is a service as opposed to a commodity or a good. The economists call them commodities. They're goods. So you're seeing some price pressure in food eating out. Food at home has come down, looking pretty good. The energy market has come down to 1.1% with declines in petroleum product prices, gasoline, fuel oil, and some natural gas. Part of that is seasonal. Part of it is cyclical and reflects trends in those energy markets. That is why you saw the headline inflation lower than the core inflation. It was because energy prices were much lower, and energy is a much more important component of what consumers buy. Core inflation, okay, headlines 2.9%. Things were down in the core inflation. Commodities, goods, and services. Services, including rents, were up. So you still have inflationary pressures in the service sector across different services, financial, housing, medical, and other. It's still very inflationary. So you have to be careful about that. You probably can't see this, but this is the Census Bureau. They came out with retail sales data for July, and it looked really good. But if you break it down, the positive data for retail sales levels was automotive purchases, the gray bars here. Automotive purchases had been very low, declined more than 3% in June, and they rebounded more than 3% in July. If you take out the auto purchases, you get the clear bars here, which is non-auto. And that was, we saw a growth in consumer spending. Demand continued to rise for retail at the retail level, but the increase was half of what it had been in June. So again, a very mixed picture. You're seeing pockets of economic weakness, sort of suggesting that the Fed should lower interest rates. But auto sales, which are extremely interest rate sensitive, rose, partly in reaction to a recovery from the June decline. I don't expect you to be able to see this. This is the industrial production data. It was down across the board. The only thing the only sector of the economy where we saw increased industrial production were non-industrial supplies. Very importantly, business equipment was one of the biggest declines at a negative 2.1% expenditures on business equipment. Business equipment is a great leading indicator because it indicates that companies are looking to expand their operations, which usually means hiring people, which usually means people have more money to spend on things like housing and autos and going out and food and vacations and everything else. So a lot of weakness here in industrial production, again, kind of suggesting that you might see a lower interest rates. Turning to the markets, gold prices continue to trade between $2,400 and $2,500. I think the price was $2,520 when I started this presentation. Our expectation is that the price will continue along these lines over the next few weeks as financial markets flip and flop back and forth. They listen to what happens next week at Jackson Hole, then they start worrying about what the Fed's going to be doing. There are some things that I should mention. There is a growing potential for any number of positive economic and political developments emerging over the next several months. Some of them are premature for CPM Group to talk about, but in the political area, you're seeing potentially more positive, less volatile, and less uncertainty in the political realm. It's going to continue to be volatile through the election, but there are signs of voter dissatisfaction with the divisiveness that has characterized the political system since the mid-1990s, at least. The much more hostile, Newt Gingrich, after the Republican-controlled Congress worked with the Clinton administration to radically change the economic supports for non-working families. And it was a big gain for the U.S. economy, and it helped boost the dollar, and it reduced the deficit spending on its way to a surplus under the last 4 years of Clinton's budgeting. And Clinton got a lot of support and popular kudos for that. Newt Gingrich, who was, I think, the Speaker of the House at the time, said, "We must never cooperate with the Democrats again. Whatever the Democrats are for, we're against it." And that was really the beginning of this extremely hostile, 3 decades long now, impasse in the economy. You didn't have Congress people trying to compromise with each other. You had a deterioration of cooperation. You're starting to see that population, the voting population, is tired of that. Whether or not Congress people have caught on, we'll find out next year after the election. Some of the most hostile people in the Congress and in past administrations are facing very tough battles, and we may see a shift away. That's hopeful thinking on my part. In addition to that, in other countries, we're starting to see domestic policies and domestic politics shift in ways that could reduce the volatility and uncertainty and hostilities within those countries, and also increase help decrease the tensions on an international political basis. We're seeing interesting developments in the Russian-Ukrainian war, which could make that less worrisome. And it is possible that we could see over the next few months some major shifts in policies related to the Israeli war in Gaza, which could also reduce international tensions. Plus, you have this mixed economic picture. If economics developed away in a more positive fashion than a negative fashion, and if some of these political factors, positive factors, emerge, you could see investors back away from buying as much gold and silver as they have been over the last 3.5 years. So it's just a cautionary tale, something to watch out for. Sometimes things get better, and investors back away from their concerns and fears, for want of a better word, that have caused them to buy so much gold and silver. It's just something to watch out for. We tend to be realists as opposed to optimists, but we are seeing some signs in a number of countries that have given us pause in our more pessimistic and negative view of the future of the world and mankind. So that's there. And then you have this market shift in sentiment away from, oh yes, interest rates will clearly be declining starting in September, to a more nuanced, more rational, realistic, balanced view. Yeah, it's a great possibility, maybe 50% chance that interest rates will start being lowered in the United States in September, but there's still a lot of inflationary pressures, headwinds against that. In that environment, we expect gold prices to continue to trade between $2,300 and $2,550 over the next several months. We still think, because we have our efforts to curb our enthusiasm and optimism about the state of the world, we still have a pretty negative view of the world, and we still think that the price of gold is likely to rise on a longer-term basis beyond September. But for the next several weeks, we're looking for that range of 2,300 to 2,550 to continue. Silver continues to suffer relative to gold. We have seen the price come down. It has come back up since that time, but it is trading between $28 and $28.50 right now in the market today. There seems to be a continued greater interest on the part of investors to buy gold than silver, and that could continue to limit the upside on silver. Longer term, we still expect record silver prices over the next couple of years, but probably not in the next 6 weeks. Okay, getting back to this question. Here's the deal. Here's a link to an old Forbes article from 2013. When Andrew Maguire burst on the scene in 2010, he had a problem. There's a PR problem. Various publications around the world, the Wall Street Journal, the New York Times, the Washington Post, NBC News, BBC, the Financial Times, and others all said, wow, this is incredible revelations that you have, and we'd like to interview you, but can you qualify yourself? Because quite frankly, no one in the London or New York markets have ever heard of you. No one at J. Aron or Goldman Sachs has ever heard of you, and you said that you worked at J. Aron. They have no records of your employment. People don't know who you are. You've never shown up at the LBMA. And we think that maybe, can you show us a pay stub to show us that you actually were a bullion dealer? And he declined to do that. We looked at it and we listened to him and we said, we think this is like a Walter Mitty type of guy. We never heard of him. We never found anybody who had heard of him as a bullion trader. We did find a couple J. Aron metals traders in London who had leased cars, antique classic cars, from Andrew Maguire. See, Andrew was a car leasing agent, first in London, and then he moved to Canada. He never traded bullion. And he had leased cars to these metals traders, and they had probably talked in a braggadocio sort of way and told them some things about gold and silver trading. I expressed those views, 2010. In 2013, I got a call from his ex-wife, who sent me his resume. We hired a Canadian private investigator who checked out everything that she had said, checked her out, and said, yes, Andrew Maguire was not a metals trader. He leased used cars. And so in 2013, at a silver summit, I mentioned that. Forbes wrote an article about it. You can find it online, and you can read about it. Ted Butler was a broker in South Florida for Drexel Burnham Lambert. And in the 1980s, he was doing several things, commingling clients' accounts without funds without permission. I hate to speak ill of the dead, but I spoke ill of him when he was alive, so I guess it's okay. He was commingling client funds, and he was trying to manipulate the, believe it or not, frozen and concentrated orange juice market. The CFTC, in its ongoing investigation of markets, found this strange trades, looked into it, went to Drexel Burnham Lambert, where he worked. They looked into it. They said, yeah, this guy is doing this. We haven't been supervising him closely enough. They paid a fine for lack of supervision and fired him. And he was facing CFTC charges. He said to the CFTC, if you go lenient on me, I'll show you how Drexel Burnham Lambert is manipulating the silver market. They said, show us what you got and we'll take it into consideration. He showed them what they got. They looked at it. They found a couple what they called match trades at the time. When ETFs were really working, you would sometimes, because dealers have to have a hedged book, it's very important, because dealers have to have a hedged book, at the end of a trading day back then, when computerization was not as advanced as it was within 10 years, you had to have a hedge book. If you didn't have a hedge book, you found somebody and said, hey, can you agree to sell me or buy from me silver or gold at this price? And then tomorrow morning, when the COMEX opens up again, we'll unwind it at that price, and I keep my hedge in place. They found, I think, 2 matched trades that Drexel had done. So they said to Ted, thanks, but that's not enough. You may no longer work in the futures and options markets and industries. So he wrote letters to just about everybody, mining executives at what was then Sunshine Mining, Hecla, Coeur d'Alene, the governor and senators of Idaho, big silver mining state, the attorney general at the time, saying, hey, Drexel Burnham is manipulating the silver market, and it's an outrage that this is happening. Well, Drexel Burnham went bankrupt, I believe, in 1989. So his tail was not Drexel Burnham, it's Merrill Lynch. They got out of the metals business in the early, like around 1994, 1995. So it wasn't Merrill Lynch, it was J.P. Morgan. We have on our website a section called Counter Arguments over Silver Conspiracies. And there are several studies that were done over a period of many years by the CFTC. We've posted them there. And there is a copy of Ted Butler's letter to the Attorney General at the time. We posted that because I had mentioned this in a speech in 2008. And Ted said that he was going to sue me because he had never alleged that Drexel had tried to manipulate the silver price. So we posted his letter to Attorney General Thornburg, in which he says, I can show you how Drexel is doing this. And then we said to Ted, Ted, here's your letter. We put it on our website to support our contention that you did this. And sorry if you don't like that. So you can read about that. So coming back, the fact that Andrew Maguire and Ted Butler don't agree with what CPM Group knows, not believes, knows, is not skin off our back, because they've been charlatans and they continue to be charlatans. Yeah, so you have to consider where you're getting your information, and you have to deal with that on a very careful and intense review. Someone was talking, everyone has agendas. CPM Group definitely has an agenda. Our agenda is to be the best precious metals and commodities research and analysis consulting company in the world, which we've been over the last 4 decades, and to make money doing that. That's our agenda. We want to be right. We want to be accurate. We want to be successful. That's our agenda. And the fact that charlatans and snake oil salesmen and carnival barkers crowd the gold and silver market and delude people into believing stuff that's not true, A, is distasteful to us, but B, it opens up vast areas of potential profitability for people who know the truth. George Soros wrote about reflexivity. If you see the market moving in one direction for reasons that you know are not valid, position yourself to make profits when the market realizes it's been had and has a reflex. There are a lot of people who made money in silver in 2021 because they watched all these people buying silver and driving the price from a very low price up to $30, and on the forward markets and for coins, $32, $33. And they said, this is all nonsense. The Wall Street silver, squeeze the COMEX, dry up the London and COMEX silver inventory. This is all nonsense. And if you knew anything about silver, you knew it was nonsense. So you could sell your silver to somebody at $32 and expect to buy it back at what? $20 within 2 years? Yep. You have to pay attention to who's telling you what and what's their agenda and what's their background. I mean, Andrew Maguire, we knew he was a fraud from the beginning because of the things that he was saying and because nobody in the precious metals market had ever heard of it. Now, that didn't get necessarily conveyed to the press, to investors, because all those news outlets that wanted to interview him and write an article about him, when he couldn't qualify himself to them, they didn't write the articles. So there was no more news. I was actually talking to Bill Murphy at GATA about this, and I said, Bill, did you qualify this guy? Did you check him out? And Bill Murphy said, we're not a news outlet. We don't have to verify the sources of our information. Yeah. When I gave that speech in 2013 and I said, oh, this is Andrew Maguire's resume, Eric Sprout went on Eric King that night to say, Andrew Maguire is one of the nicest guys I know, or something like that. Yeah, well, yeah, if you're underwriting this guy because he's helping you convince investors to buy gold and silver based on conspiracy theories, yeah, you could say nice things. It's nonsense. Sorry that I had to go into that. I do feel weary about having these off-based comments. People need to stop reading garbage. They need to stop believing it. They need to do their homework. And they need to stop feeling compelled to share their beliefs based on misinformation with me and with everybody else. If you want more information, CPM Group has Precious Metals Advisory. We have gold, silver, platinum yearbooks. We have consulting services. We have shorter term reports. We have special market reports and market commentaries. There's a history of reports that we have posted for free. Monex, one of our clients, has reports. You can go to monex.com and see our current reports, and I think they have a library of historical reports. We also post Monex and Gold Bullion International and CPM Group reports on Bloomberg, and I believe we're doing that now again on the London LSEG website, and we're trying to get them onto our own website too. There's a lot of information out there. People pay us to be right and honest and unbiased. In the future, I might talk about some other gruesome errors in the markets, like, for example, the fallacy that when producers sell forward, somehow or other that involves the sale of a spot physical metal to cover or hedge that forward sale, which doesn't make sense, but that's beside the point. And it skews all of the data. And cumulatively, it skews the data by enormous volumes over time. Might talk about that as another thing to watch out for in the future. We have produced our 10-year updates. You may speak to us about them and how to plug into them. And you can go to our website, get free reads, buy our books, send us an email at info@cpmgroup.com and say, I want to get on your client list so that I can avoid the pitfalls of listening to charlatans and believing what they say. That's all I have for now. Sorry I went long, 38 minutes. Have a good weekend. Take care of yourself. Be good to others. Be good to the world. And we'll talk to you next week.